Hi there, welcome to Kneppy Invests. Time to do update 22 to the performance of Kneppy's portfolio. Can't believe it's been 2 weeks since the previous update, and I just can't believe it's update 22. So I set up this portfolio or this strategy in August of 2020. So it's been 9 months. So we're almost 3 months to the day or to the first year anniversary of this portfolio. And the whole reason I decided to set up this portfolio and compare it to a benchmark was because of a lot of things I was hearing from experts, and not only just experts, but just people on the street, people I knew at work, who said the individual investor cannot beat the market, and we just should just put our money into a market tracking ETF. I do not believe that. I believe if you do put the time and effort into investing, you will be able to beat the market quite considerably. And I just wanted to test that. And that's why I set up this portfolio to track the benchmark. There's another reason I set up this portfolio. It's just to see how this strategy performs, because it was a new strategy I had developed. I just wanted to see how it performs against my original strategy, which was simply buy a company you liked and thought it had a good future and just hold it as long as possible. So it's been performing quite well since August of last year. It is double the market returns. So I am showing that you can beat the market. I'm not smarter than most people out there, and if I can do it, everyone else can do it if you put the time and effort into it. And I don't put that much time. In fact, I spend most of my time in investing now doing these videos. So I spend maybe 30 minutes to an hour each day on the stock markets and looking at companies. So that's about I'd say 5 hours a week I spend in my investing, and I spend way more time doing these videos. Kneppy's portfolio philosophy or strategy is quite simple, and it's all about breakouts in the share price, preferably on positive announcements. And when I'm talking about positive announcements, we're looking at fairly powerful announcements, and those are usually in regards to financial updates, so profit upgrades, trading updates. Those are sort of announcements I'm looking at every day. And we also can buy into a company when there's a shift in momentum and sentiment. When those two align, when you get a breakout in the share price at the same time where there's a shift in momentum and sentiment, that's a very powerful move. And that's my preference when I'm buying into a company, when I see both of those coincide at the same time. And likewise, when it comes to selling, if I see any negative announcements from a company, particularly a trading update, which would be a profit downgrade, that sort of thing, or just a simple shift in momentum and sentiment, that would be a sell signal for me. So those are my buy and sell signals in this portfolio. Before I get into the performance of Kneppy's portfolio and look at individual companies, I always like to look at the macro environment and the performance of the overall market. And when I look at the performance of the overall market, I focus on the XGO, which is the ASX 200. We have been trading in this upward sloping channel since November of last year. And on the first day of last trading week, on the Monday, we did see the XGO go above the top of the trading channel. And that would have been a bullish move if it kept on going, but it was a false breakout because the next 3 trading days were big down days. And we have seen 3 big trading down days in the past, and usually once you see 3, the next day usually is positive. And that's exactly what we saw this week. We saw good up days on Monday and the Friday, and in between those 2 up days, we saw 3 big down days. Really interesting to understand or try to understand why we had 3 big down days during the week. And it all has to do with inflation fears throughout the world. And on my first night shift, I did 2 night shifts this week. And on the first night shift, United States released their CPI figures for the month of, was it March or April? I think it was March. And it was considerably higher than expectations. In fact, it was 1% in the month. So CPI went up 1% in 1 month. That's quite high. And the market reacted to that news to the downside, understandably, particularly in the tech stocks. I think the NASDAQ on that day was almost down 3%. Last time Australia released their CPI figures, it was actually lower than expected. And in fact, the Australian markets went up on that news. So it's really interesting to see what's happening throughout the world in regards to inflation. We're getting a lot of reports of inflation out there when individual companies are reporting. Berkshire Hathaway had their annual general meeting, was it 2 weeks ago, and even Warren Buffett said a lot of his companies are facing inflation rises in their supply costs, and they're passing that on to consumers. So consumers are paying more for all these products that are being affected by supply cost increases. We've already seen one company on the ASX, I forget which company it was, who said they've experienced the same thing and they're passing it on to the consumers because they have the pricing power. Also, during the week, it was really interesting. There was one company on the ASX who reported, it was a mining services company, Perenti, I believe. Yes, I'm pretty sure it was Perenti. And their share price went down 25% because it was a profit downgrade. And one of the reasons they had a profit downgrade, so I think they went through about 3 or 4 reasons behind the lower performance than expected. And one of the reasons they did give was a tightening labour market. So there's more demand for labour out there, and the supply is not keeping up with that demand. And everything's about supply and demand. Inflation's about supply and demand. The labour market is about supply and demand. And what Prenti is finding is there's not enough labour for all the demand out there. And if there's not enough supply, that means they have to raise the wages. So we are potentially starting to see wage increases throughout their economy. And started to see the first signs of that within this mining services announcement from this one company. It's the first sign I've seen, but it shouldn't be a surprise because we are seeing news reports come that there's a lot of service industries, companies within service industries like restaurants, having a hard time to find employees. And in fact, this is definitely true in the United States. A lot of restaurants are having to close business because they don't have enough staff. Now, that's a problem in the United States. Centered around how long restaurants have taken advantage of their employees with low wages, low benefits, that sort of thing. And all these employees have been looked after from the government or by the government for the last year or so, and they've had it fairly well. And they've compared how well they've had it in the past year because they've been well looked after by the government, and they compare that to how badly they've been treated by restaurants, and they said, well, why should we have to put up with that? And right now, that shows you there could be a bit of a revolution happening in that industry right now as I speak. I'm not sure if that's happening in Australia, but I have noticed, I've heard there are a lot of help wanted signs out there, a lot of jobs popping up, and there may not be enough people to cover all those jobs. And if there's not enough people to cover all the jobs that are popping up, that's when you start to see wage rises. And the government has said, we're not going to increase interest rates until we start to see wages rise. And they've said that's going to take another 3 years. And right now, it's going to be completely out of the control of the government or the central bank. Not the government, it is the central bank. Because they say they're going to wait 3 years before. They don't expect interest rates to rise until another 3 years, 2024 or something like that, because they don't expect wages to rise until then. But we're starting to see the first signs of wages starting to rise. So don't be surprised, particularly if we start seeing inflation rise, wages rise, that interest rates have to be increased as well to keep that under control. And I almost forgot to mention that over the past 2 weeks, the XAO was almost flat, only down 0.2%, which looks pretty weird when you look at the chart at the left hand, but that's actually the truth. 2 weeks ago, it was at 7025.8, now it's at 714.2. The top was just shy of 7,200, so we have fallen a fair bit from the recent high, but it's still, over the past 2 weeks, relatively flat. A little bit of activity in regards to the makeup of Kneppy's portfolio. I did make 3 disposals and 4 acquisitions. So this time of year, I do expect to be a little bit more active because we do see quite a few trading updates around this time of year before we head into reporting season. and that comes around in August. So this is confession season, as some people like to say, and that's just before we move into reporting season. So we will see a lot of these trading updates come through. We've already seen a lot in the past month or so, and we'll see a few more. And as companies say, well, they're performing better than they expected or worse than expected, we're going to see quite a few companies' share prices increase or decrease on the back of that. So the three disposals I make this week this fortnight, were Cleanspace respirators, and I think that was a little bit. I'll talk about why I sold that when I get to it. I should never have bought it in the first place. Pushpay, that was a failed breakout, and Treasury Wine Estates, that was really going nowhere, going backwards. And then a few days ago, they released a positive trading update, and the share price is starting to increase. So looks like I timed that disposal a little bit badly, because there is now a potential buy opportunity with Treasury Wines. Who would have thought that? The four companies I acquired during the last fortnight were Kathmandu, Bravura, Cettire, and Aeris Resources. I've already done a video on Kathmandu, so if you want to really take a good look at why I bought into that company, just look at that video. I might do a video on Bravura, and I've bought back into Aeris, which is actually an interesting story, which I'll get to in a few slides or not. But before I get there, just want to talk about the overall performance of the portfolio. Over the past 2 weeks or fortnight, Kneppy's portfolio has gained 1.7%. And the vast majority of those gains were attributable to Aeris Resources, up 67% from where I reacquired that company. Cettire did very well as well, 14%. Hammer Metals up 6.4%. And the three worst performing companies, two of those are my best performing companies overall. They are TPC Consolidated, down 13%, and Dusk, down 10%. The other worst performing company was EML Payments, down 10%. The main reason that was down, or one of the worst performing companies, was because it's considered a tech company, and tech stocks have been taking a bit of a hit during the past fortnight. So before I talk about the acquisitions I made and focusing on areas of resources, I'm just going to talk about the performance of Kneppy's portfolio compared to the benchmark over the past 3 months and since inception. Over the past 3 months, Kneppy's portfolio, which I call MSP in share sight, is up 18.8%, while the STW, which is the ASX 200 benchmark, is only up 4.8%. The three best performing well-known companies were Dusk, up 34%, Pact Group 25%, and SG Fleet up 21%. It's really good to see those two last companies performing quite well, because they wouldn't be considered growth companies or companies that a lot of long-term holders would consider as good buys. So this just shows you that sometimes in this strategy you can buy companies that wouldn't be considered long-term holds, and you can still make a little bit of money out of them. So very happy, particularly out of Pact Group. That was a very old holding of mine when they first IPO'd, or they may not have IPO'd. I think they could have been spun out of another company. Now on to the performance of Kneppy's portfolio versus the benchmark since inception, or August 13, 2020. Before I talk about the comparison between the performance of these two, I just want to talk about the ultimate goals and aims. So the ultimate aim of this portfolio is to beat the market returns. The main reason you want to beat the market returns is because if you're putting some time and effort into your investing and you can't beat the market returns, then you're really wasting your time. You could just be reading a book, going to the beach, watching movies, and that'd be more efficient use of your time. But when you're able to beat the market returns, that's showing you there is a benefit to putting some time and effort into your investing. The ultimate goal, however, is to double the market return. So I do have some high aspirations there. And the main reason I want to double the market returns is because that's what Warren Buffett and Peter Lynch did with their funds, or actually they are doing in Warren Buffett's case, because he's still running. They were able to beat the market or double the market returns over a long period of time. And that's a really good aspiration to have, is to try to get those returns on your portfolio. So at this point in time, Kneppy's portfolio is tracking at 36.4% compared to the STW, which is up 17.6%. So right now I am double the market returns. So at this point in time, putting time and effort into my investing is beneficial, and I'm not going to stop doing it. There's no way at this right now I'm going to put my money into an ETF and get average market returns. The best performing companies in the portfolio since inception, 3 of them I still own: TPC, Aeris Resources, which I've just bought into, and Dust Group. And the other 2 companies, BlueScope Steel and the Citadel, have sold out. Unfortunately for Citadel, they were bought out by another company, so I really had no choice with that. While in the BlueScope Steel, they just their share price had increased 55%, and I really had no sell strategy for them. And unfortunately, I think I sold out a little bit too soon, but lesson learned. The first company I want to talk about today is Aeris Resources, and this is a fascinating topic because the reason I bought into this company was twofold. I'll talk about that in a second or so, and this also was the best performing company of the week. Now, the reason I sold out of this company a few weeks ago was because they released their quarterly report and the market didn't like it. I was slightly negative about it as well, so I sold out at around 10 cents. I did have a bit of seller's regret after that because I did hold this company from 5.6 cents to 10 cents. And I do think they have a bright future ahead of them, but you just got to read what the market is saying. So I decided, because the market reacted negatively to their quarterly report, I decided to sell out and listen to the market. Share price actually did go below 10 cents for a few days and then went above 10 cents, and that's when the seller's regret really took off. And I just wanted some reason to buy back in. And then I got my reason, I think it was the 11th or 12th of May. Helix Resources went into a trading halt. So you might be saying, why am I talking about Helix Resources here? And this trading halt was in regards to exploration results. Now, there is a relationship between Helix and Aeris Resources. They do have a joint venture with it was called Kathmandu. Helix has 70% stake in that, and Aeris Resources have 30%. Now, when they released this trading halt, I did think, because of exploration results, it could have been about their joint venture. I wasn't definite, but I thought it could be. And if they went into a trading halt about the exploration results, more than likely it was going to be positive. At the same time, Aeris Resources kept on trading, so I decided to take a bit of a punt and buy back in Aeris Resources at 11 cents. So 1 cent higher than when I sold out. So this actually does show you, and I'm learning this lesson, I have been learning this lesson over many years, that just because you sell out of a company doesn't mean that should hold you back from buying back in at a higher price. So I bought back in 11 cents just because there could have been some positive results in regards to Helix's exploration results. And lo and behold, the next day, they released their announcement in regards to massive copper sulfides intersected in second hole at Kathmandu, and Helix share price went up 170% on that day, and Aeris Resources in response went up a lot as well. And funnily enough, Aeris Resources actually didn't release an announcement until about 1 hour after trading begun. There's a lot of confused people why Aeris Resources share price was running hard. It was all because of this joint venture with Helix Resources. So that was a very fortuitous buy. But in my opinion, that was a strategic buy based off potential of a really good announcement that was going to affect Aeris Resources, and it did pay off. I was surprised by how much the share price ran on both Helix and Aeris Resources. Helix actually went into a trading halt on the Friday in regards to a capital raising. So it's one negative thing about Helix. I am quite interested in that company, but I did think they might do a capital raising because the share price ran up so much. You see that a lot. When a share price runs up a lot, management takes advantage of the higher share price and sometimes do capital raisings. And then on that day, Aeris Resources, last day of trading week, Aeris Resources share price went up 20% and is at 17.5 cents as we speak. Another company I bought during the last fortnight was Cettire or Cettire. I'm not sure how to pronounce this company. I've heard it pronounced 3 ways, and probably the best confirmation of how to pronounce it would be to listen to the CEO speak, but I haven't heard the CEO speak at all. Anyway, nice uptrend since they IPO'd in December last year at about 50 cents. So it got to a high of about $1.80 recently, and they did release a profit upgrade on the 3rd of May in regards to their prospectus guidance. And typically when a company issues a profit upgrade, the share price will increase. But in my opinion, this is just an opinion of mine, the reason why the share price fell on this profit upgrade was the market expected more, so they expected a better upgrade than this. So the share price dipped back towards $1.40, and then the day before I bought in, the share price bounced off $1.40 or the 50-day moving average, and that's sometimes the 50-day moving average can be a bit of support, and in this case it was. And then the next day we did see the share price increase a little bit further, and that's where I bought in on the dip. This is the first time I've ever bought on a dip. I've always laughed at this concept in the past, buy the dip. You should always buy the dip. Share price decreases, buy the dip. And this is the first time I've ever bought the dip. The share price has increased further from there. And one of the reasons why it has increased was Investing Service has put a recommendation on this company. We won't talk about who that investing service is because it is a paid service, and that would be wrong, I think. Anyway, share price did get to $1.80 a few days ago on the release of this recommendation from the investing service, but has pulled back a little bit. It does look like $1.80 is a good resistance level, and if the share price pulls through $1.80 on good volume, that would be a fairly good buy signal or a buy another parcel signal for me. Third acquisition I made during the week or fortnight was Kathmandu. I did do a video on this company, so if you want more information of why I bought into this company, look at that video. If I remember, I put a link into the description of this video. Long story short is we did see a long period of consolidation, and the share price broke out in the half-year results in March. You can see that breakout on good volume, and the share price has been going up ever since. A nice looking uptrend developing, and that's the reason I bought in. It went through $1.35, which was a breakout of a resistance level, and that was my buy price. The final acquisition for the week was Bravura. This had been in a long-term downtrend for a while, I think for a few years at least, and we are starting to see in the past few weeks a turnaround in the share price. You can definitely see that. Just looking at the chart, we are seeing a higher high, higher low setup, and the moving averages have shifted around. Share price is now above the 3 moving averages, which is always a good sign, and decided to buy into Bravura. The overall reason why this company might be recovering is the reason why they've been in the downtrend is because of the UK story. So they do have operations in the UK which have been depressed by COVID-19. And as UK recovers from COVID-19, we will see Bravura recover because their business in that country, in that area, will start doing quite well. Now on to the disposals for the week. First one is Pushpay. This was a sort of a disappointment. The whole reason I bought into Pushpay was because it looked like there was an uptrend developing. That uptrend broke a few weeks ago at about $1.75, and the share price kept falling. So this was a natural sell signal. They did release their results, financial results, the other day. The market did not react at all, either way, up or down with those results. So no trend with Pushpay at right now, so there's no reason to hold it. Share price could go either way from here. I just don't know. And when I don't know, there's no reason to be holding it. Just like Pushpay, Treasury Wine Estates share price was looking fairly weak in a nice looking or developing downtrend. Share price was very slowly going down. It seemed like every single day it just went down a little bit more. Unlike Pushpay, or actually just like Pushpay, they did release an announcement to the market the other day. So Pushpay had the half yearly or yearly, and Treasury Wine released a trading update. The trading update was quite positive, and you can see that with the share price actually rising from about $10 to $10.84 at close of trading on Friday on really good volume as well. So we have a potential breakout in Treasury Wine's share price on positive news with higher volume and even a possible shift in momentum and sentiment. Might have to wait a few more days for confirmation of the shift in sentiment and momentum. So a potential buy here right now for Treasury Wines, even though I just sold out. So I'll keep my close eye on Treasury Wines, but this announcement was quite important because they're saying, or they said, that they are turning things around. The final disposal for the week was Cleanspace respirators. And if I was being honest with myself, I should never have bought into this company in the first place. I was sort of moving towards some things I had done in the past, which was when I saw the share price decrease like 50% in one day, I'll buy in and just wait for the bounce. And really for Cleanspace, the bounce never occurred. And really that acquisition never really fitted into my investing philosophy. There was no breakout in the share price. There was no shift in momentum or sentiment. So to stay true to my investing strategy, I decided to sell out of Cleanspace. I'll keep my eye on it and just wait for some good news in the future, wait for the momentum or sentiment to shift. But up until then, we just don't know what's going to happen with this company. They could give out a couple more downgrades in the future because they do say downgrades comes in 3s, or for A2 milk it comes in 4s. So those are the reasons I sold out of Cleanspace. Just remain patient, wait for the turnaround story to play out, or wait for some proof that the company is turning things around. Now on to a few updates about companies I've held for quite a while. And a few of these companies I've held for over 9 months now. I'm going to have to think a little bit more about whether I should sell out of these companies if I get a sell signal, or keep holding them until I've held them for 1 year. Because if you hold a company for 1 year, your CGT does go down. So I bought South 32 on the 12th of August last year at $2.23. And this is the weekly chart, so the 3-year weekly chart. And just by looking at the weekly chart, you can see our South 32 has gone into a nice looking uptrend, a very slowly moving uptrend. But that's what I like. I like slowly moving uptrends. And the share price has only increased 70%, but that's still almost a 33% gain in 9 months. And if you can get a 33% gain in any company you own over a 9-month period, you're going to take it. Now on to SG Fleet. And this is another example of a nice looking chart, a shift from negative to positive sentiment. And this occurred in November of 2020. I was using a combination of daily charts and weekly charts to decide when the sentiment shifts. And this is the 3-year weekly chart here. You can definitely see the sentiment shifting, starting to shift towards the start or middle of 2020. And we get the confirmation of that shift in November of last year when the share price moves above all 3 moving averages. You can see that on the weekly chart, but even on the daily chart, we had the signal in November last year. So I bought SG Fleet at $2.17. It has risen since then to $2.96. So that's just shy of a 40% gain. So when you can get a 40% gain in 6 months for a company like SG Fleet, you'll definitely take that every single time. The final company I want to talk about is Pact Group. This is actually one of my favorite companies on the ASX right now, simply because the share price of Pact Group was in a long-term downtrend. We did see the share price get to a high of 7 a few years ago, and then fell all the way to about $1.50 during the COVID-19 financial panic. A lot of experts in recent times have said this is definitely not a buy. There's no long-term future for this company. There's no reason to buy in at all. But we have been getting buy signals with Pact Group over the past 4 or 5 months. In fact, the turnaround in the share price really began in the middle of 2020. You can see the moving averages come together, and then the share price moved above all 3 moving averages. So we started to see the sentiment and momentum shift in Pact Group towards October, November last year when the share price was $2.50. But I got the breakout signal, the buy signal with Pact Group on the 19th of February when they released the half-yearly results. Very positive results from the company, and we saw the share price break above a resistance level on high volume. One of the most obvious buy signals I've seen for quite a while. And from then, the share price has increased 25% from $2.98 to $3.67. And that's only been in 3 months. So if you can get a 25% gain in a company like Pact Group, which all the experts hate, over a 3-month period, it just shows you can get good gains out there for companies that are unloved by the experts. That is all I've got for this update 22 for the performance of Kneppy's portfolio. If you have any questions or any comments, I love to read them, so leave them in the comment section. I'll answer those questions as soon as possible. Otherwise, I'm not a financial advisor, so if you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's all for this video. Have a good day. Bye.